In 1998, a single number on a Bloomberg screen made traders freeze. The Japanese yen surged 15% in just 2 days. No war, no crisis, just the sudden reversal of a silent mechanism that had been feeding global markets for years: the yen carry trade. For decades, money had been borrowed in Japan, where interest rates were near zero, and sent abroad chasing higher returns. It was invisible, elegant, and dangerously simple. Borrow cheap yen, convert them to dollars, invest in anything that paid more. Hedge funds, pension funds, even banks joined in. The profits were steady, until they weren't. Because when the yen rises, the trade collapses. Suddenly, those borrowed trillions must be paid back in a currency that's now worth more. Positions unwind, assets are dumped, liquidity disappears. The chain reaction doesn't start in Tokyo. It starts everywhere else. Few outside the financial world noticed. To most, the yen was just another line on a chart. But to insiders, it was the quiet pulse of global leverage, a signal of how far the world's financial system had stretched beyond real growth. Behind the calm facade of Japan's low rates lies something deeper, a hidden dependency. Every time central banks promise stability, investors build towers of risk on borrowed foundations. The yen carry trade was not an anomaly. It was a template. And the numbers today are staggering. Analysts estimate that more than $20 trillion in global assets are still entangled in similar strategies, directly or indirectly dependent on the same logic. Cheap yen fuel expensive assets. It works beautifully until the flow reverses. When that happens, markets don't slide, they snap. The yen isn't just a currency. It's the quiet hinge of the global financial machine. And if it turns the other way, the world will discover that what looked like liquidity was in fact leverage. If this opened another side of history for you, comment where you're watching from. To understand why the yen became the world's cheapest funding currency, we need to go back to Japan's lost decades, the longest economic stagnation in modern history. In 1989, the Nikkei index stood above 38,000 points. Real estate in Tokyo was so expensive that the Imperial Palace grounds were said to be worth more than all the land in California. And then it ended. The asset bubble burst with a precision that economists still study like a slow-motion disaster. Stock prices collapsed. Property values plunged by 80%. A generation of wealth vanished. The Bank of Japan responded the way any central bank would. It cut rates. Then it cut them again and again. By 1995, Japan's policy rate was near zero. It has barely moved since. The intention was to revive growth and inflation. Instead, Japan created a strange equilibrium, a world where money was almost free, but confidence was gone. Investors outside Japan saw opportunity. Cheap yen could be borrowed almost indefinitely. The logic was mechanical. If you can borrow at 0.1% and invest at 5%, the spread is pure profit. It didn't matter whether the investment was in U.S. Treasuries, Australian bonds, or emerging market stocks. The pipeline from Tokyo to the rest of the world became a permanent fixture of global finance. But this was not an official policy. There was no announcement, no treaty. The yen carry trade was born from collective behavior, millions of rational decisions converging on the same illusion of safety. Money flowed out of Japan like water seeking gravity. Through the 1990s and 2000s, this flow underpinned nearly every boom. It helped fuel the rise of tech stocks, the housing bubbles, and even the commodity supercycle. Japan's internal stagnation paradoxically became the external energy of global growth. The world borrowed Japan's silence and turned it into noise. And beneath it all lay a simple assumption: the yen would stay weak. That assumption was treated like a law of physics, because if the yen suddenly strengthened, the carry trade would implode, not gradually, but violently. It had happened before. In 1998, during the Asian financial crisis, hedge funds scrambled to unwind their yen positions as markets crashed. The yen surge nearly broke long-term capital management, the most sophisticated hedge fund of its time. The contagion reached Wall Street within hours. Central banks had to coordinate an emergency bailout to prevent systemic collapse. That was the warning. But the lesson wasn't learned. It was monetized. By the 2010s, the scale had multiplied. Japan's central bank launched massive quantitative easing, buying government bonds and exchange-traded funds in an attempt to generate inflation. Instead, it flooded the world with even more cheap yen. Global markets absorbed it like oxygen. Every dollar of Japanese liquidity created leverage somewhere else, in New York, London, Hong Kong. The carry trade became a structural part of the global system, not a temporary strategy. What began as Japan's domestic rescue became a global addiction. Low rates were no longer a tool, they were the baseline. And as other central banks followed Japan's path, the distinction between local and global vanished. Today, the yen's weakness is seen as stability, but history suggests the opposite. When stability is priced in as permanent, it becomes the most fragile thing in the world. If this gave you a new lens on how global finance was built, tell me where you're watching from. The system worked until it didn't. In theory, the yen carry trade was self-balancing. As long as interest rate differentials remained wide, investors would keep borrowing yen and selling them for higher yielding currencies. But global stability is not a natural state. It is a negotiation among expectations. And when one side stops believing, the other collapses. The first cracks appeared in late 2007. The yen started to rise, quietly at first. It wasn't Japan that changed, it was the world. The US housing market was breaking apart, and global investors were rushing to unwind risk. Suddenly, those with massive yen-denominated debts needed to buy yen to close their positions. The result was a paradox. The more they unwound, the stronger the yen became. In October 2008, as Lehman Brothers collapsed, the yen surged to its highest level in 13 years. The move was not driven by Japanese growth, but by global panic. Trillions in leveraged trades had to be reversed at once. Funds sold assets from Brazil to London, from corporate bonds to emerging currencies, just to cover yen exposure. What had been invisible became visible and destructive. The carry trade was supposed to be a harmless arbitrage. In reality, it was a global amplifier. Every dollar borrowed in yen was a silent promise that tomorrow would look like today. When that promise broke, the chain reaction spread through every market connected to liquidity. Japan's zero rates had made the world rich in leverage but poor in resilience. Hedge funds that had prospered for a decade faced margin calls. Banks found their balance sheets unexpectedly exposed to currency volatility. Even companies with no direct link to Japan saw their financing costs explode. And yet, after the crisis passed, the same pattern returned, only larger. Central banks cut rates to zero. The Bank of Japan went further into negative territory. The European Central Bank followed. The Federal Reserve launched waves of quantitative easing. The global financial system was rebuilt on the same foundation: cheap funding and the illusion of permanence. By the 2010s, the yen's role as the funding currency had become institutionalized. Pension funds borrowed in yen to buy higher-yielding U.S. assets. Corporations hedged dollar debt through yen swaps. Emerging market governments issued bonds indirectly linked to the yen's value. The chain was no longer speculative, it was structural. Then came 2022. Inflation, dormant for decades, returned. The U.S. raised rates faster than at any time in history. Japan did not. The yen collapsed to its weakest level since the 1990s. That collapse triggered a new imbalance, the reverse of 2008. Now, it wasn't a strengthening yen that threatened the system, but a weakening one. The trade became one-sided. Borrowing in yen was almost risk-free, and capital poured out of Japan again. But a system stretched to one extreme becomes hypersensitive to the opposite. Every hint that the Bank of Japan might tighten policy sends tremors through global markets. A small shift in Japanese yields could set off a $1 trillion unwind. And the numbers are breathtaking. By some estimates, global investors have leveraged up to $20 trillion in strategies ultimately tied to the yen's cheapness, from cross-currency swaps to synthetic bond positions. Not all of it is visible on balance sheets. Much of it exists in the shadow banking world, where risk is recycled, hidden, and renamed. This is the quiet danger. Nobody knows where the yen exposure truly ends. It seeps through derivatives, structured notes, and offshore funds, a spiderweb of obligations whose total size exceeds the GDP of the United States. And yet the headlines remain calm. The yen weakens again, they say, as if this were a local event. But it isn't. It's global oxygen thinning. When the unwind comes, it won't look like a Japanese crisis. It will look like a liquidity drought everywhere else. The yen carry trade is not a story about currency. It's a story about belief. Belief that the system can stay unbalanced forever. If this shifted how you see stability, tell me where you're watching from. At its core, the yen carry trade is a machine, not a metaphorical one, a literal financial mechanism built on interest rate differentials, currency conversion, and leverage. To understand how it operates is to see how the modern world manufactures returns out of thin air. It begins with the Bank of Japan. When its policy rate stays near zero, the cost of borrowing yen is almost nothing. A hedge fund, or even a corporate treasury, can take a short-term loan in yen at 0.1%. That yen is immediately sold for dollars, euros, or Australian dollars, whichever currency offers higher yields. The borrowed yen becomes fuel for buying foreign assets. Now imagine multiplying that transaction by thousands of institutions. Each one adds leverage, borrowing not once but 10 or 20 times the initial capital. The returns are thin, but when magnified by leverage, they become enormous. A 1% yield difference turns into a 10% profit. The secret lies in the assumption that exchange rates will not change dramatically. If the yen remains stable or weakens, the trade works perfectly. Borrow low, lend high, repeat. The system becomes self-reinforcing. As more investors sell yen, the currency weakens further, making the trade even more attractive. But this machine has a hidden switch, the currency risk. The moment the yen strengthens, the math reverses. Every dollar of profit becomes a dollar of loss. Margin calls appear. Lenders demand collateral. To cover their exposure, investors must sell the assets they bought, often U.S. bonds, European equities, or emerging market debt. Selling drives prices down, which triggers more selling. The unwind becomes reflexive. This is why the yen carry trade behaves like a global amplifier. It multiplies small shifts in currency into global shocks. It's not the size of the yen market that matters, it's the leverage built upon it. Think of it as a mountain of ice balanced on a single cube. The cube is Japan's yield policy. The mountain is the rest of the world's appetite for risk. Derivatives make the structure even more opaque. Many institutions no longer borrow yen directly. Instead, they enter currency swaps, contracts that synthetically replicate the carry trade. A U.S. pension fund might use a cross-currency basis swap to convert dollars into yen, hedge the exposure, and still capture the rate spread. On paper, it doesn't look like a loan. In reality, it's the same trade wearing a different name. By 2023, the scale of these swaps had become enormous. According to the Bank for International Settlements, over $80 trillion in global financial contracts involved off-balance sheet dollar and yen positions. Not all of them are carry trades, but many share the same sensitivity. A stronger yen means losses. That is why a small policy signal from Tokyo can ripple through every trading desk in New York. When the Bank of Japan hints at raising rates or tightening yield curve control, algorithms react instantly. Hedge funds close positions. Treasury yields move. Stocks wobble. It's not sentiment, it's math reacting to gravity. The irony is that Japan's own economy benefits little from this machine. The capital leaves its borders, inflates asset prices abroad, and rarely returns home. Japan exports liquidity, but imports volatility. Its stability feeds the world's instability. And now, the equilibrium looks fragile again. Japan's inflation has quietly risen above 2%, and pressure is mounting on the central bank to normalize rates. But normalization in this system is a euphemism for detonation. A single percentage point increase in Japan's rates could unwind trillions in leveraged trades worldwide. What began as a harmless yield gap could end as a synchronized margin call across continents. Because the carry trade is not built on profits, it's built on borrowed time. If this revealed how leverage hides in plain sight, comment where you're watching from. When the unwind begins, it doesn't announce itself. It spreads quietly, like pressure shifting under ice. The first victims are always the most leveraged. Hedge funds holding complex cross-currency positions start receiving margin calls. Overnight, their models fail, not because of bad strategy, but because the assumptions baked into the equations no longer hold. The yen moves faster than the algorithms can hedge. What was once a stable funding base becomes a runaway liability. Liquidity vanishes next. Dealers refuse to roll over swaps. Spreads widen. Cross-currency basis swaps, the plumbing of global finance, begin to distort. A few basis points turn into 20, then 50. That may sound small, but in a system built on trillions, it's a scream. Then the contagion hits credit markets. Funds forced to unwind yen exposure must sell whatever they can. Corporate bonds, emerging market debt, even U.S. Treasuries. The selling is indiscriminate. Prices fall, yields rise, and investors everywhere feel the same invisible hand tightening around their portfolios. In 1998, this sequence nearly destroyed long-term capital management. In 2008, it magnified the global crash. Each time, the mechanism was the same. Borrowed yen, leveraged bets, sudden reversal. The losses weren't isolated to Japan. They were global, systemic, recursive. And yet the memory faded, because every time the system broke, central banks stepped in. Liquidity injections, swap lines, coordinated easing, emergency oxygen for a patient that refused to change its habits. The yen carry trade would die in one form and be reborn in another. After 2008, the pattern became institutionalized. The Bank of Japan's quantitative easing continued without pause. By 2020, it owned more than half of Japan's government bonds and a major share of its equity ETFs. Yields were pinned to the floor. Investors stopped questioning whether the yen could ever rise again. But in doing so, Japan created a global dependency it couldn't control. Every investor who borrowed in yen effectively tied their stability to the Bank of Japan's policy decisions. A shift of 10 basis points in Tokyo could erase months of profits in New York. When inflation returned in 2022, that dependency turned dangerous. The Bank of Japan faced an impossible choice: raise rates and trigger a global unwind, or hold steady and watch the yen collapse. It chose the latter, for now. The yen weakened to levels unseen in 30 years. Import prices soared. Japan's own citizens began converting savings into dollars, fearing further devaluation. The irony was cruel. The country that had once exported deflation was now importing inflation. The system designed to stabilize Japan had made it hostage to the very flows it created. Outside Japan, the effects were harder to see, but no less real. A weaker yen meant stronger dollars and tighter financial conditions everywhere. Emerging markets saw capital flight. European exporters lost competitiveness. U.S. investors faced volatility spikes as currency hedges unraveled. Every market that had fed on Japan's cheap money now had to survive without it. And still, the surface looked calm. Stock indices rose, corporate profits held. Analysts spoke of resilience. But underneath, the architecture was cracking. Global debt reached 350% of GDP. Leverage hid behind derivatives and structured notes. The yen remained the silent denominator of that risk, the trigger few accounted for, but all depended on. If history is a ledger, this chapter will read like a warning. The world built wealth on a mispriced currency and mistook cheap money for stability. Because every system built on permanent imbalance eventually seeks equilibrium, and when that balance returns, it doesn't ask for permission. If this helped you see what stability really costs, tell me where you're watching from. History never repeats, it compounds. What began with Japan's zero-rate experiment in the 1990s has quietly become the DNA of global finance. The yen carry trade is no longer a Japanese invention. It's the blueprint of the modern economy. When the Federal Reserve cut rates to zero after 2008, it essentially recreated Japan's system, only larger. Trillions in liquidity flowed into risk assets. The logic was identical. Borrow cheap, buy yield. The names changed: quantitative easing, liquidity facilities, balance sheet expansion, but the mechanism didn't. Then came the European Central Bank, the Bank of England, the Swiss National Bank. Each promised temporary ultra-low rates. Each extended them for years. Global markets learned that cheap money was no longer a policy tool, it was a condition of survival. By the 2010s, the entire planet was running its own version of the yen carry trade. Investors borrowed in whatever currency offered the lowest rate, yen, euros, Swiss francs, and poured that money into US tech stocks, corporate bonds, and real estate. The world's wealth became a single interconnected bet on low volatility and endless liquidity. Even retail investors joined the game. Cheap credit cards, margin loans, and online brokerages turned households into miniature carry traders. The difference between the cost of money and the return on assets became a lifestyle, not a trade. And yet, the logic remains dangerously unchanged. It all works until the funding cost rises. In 2022, the global mirror cracked again. Inflation, long dismissed as extinct, returned. Central banks scrambled to raise rates, but Japan didn't. The divergence was historic. U.S. yields rose above 5% while Japanese yields remained near zero. The gap created an even bigger carry trade as investors borrowed yen to chase U.S. returns. At first it looked harmless, a continuation of the old pattern, but in truth it created a time bomb. Because if the Bank of Japan ever allows its yields to rise, all those leveraged positions will implode. Not metaphorically, mathematically. The entire trade is built on the assumption that the cost of yen remains near zero. If it doesn't, the unwind will be instant. And the risk today is greater than ever. The yen's weakness has already crossed psychological thresholds unseen since the 1990s. Every tick higher in Japanese yields tightens the screws on global liquidity. The world's largest funds, from U.S. pensions to sovereign wealth funds, are quietly exposed through currency hedges, swaps, and derivative overlays they barely control. In 2023 and 2024, we saw hints of what such an unwind might look like. The Bank of Japan adjusted its yield curve control, allowing 10-year yields to rise modestly. The yen jumped. Within hours, global bond markets shuddered. It was a microcosm, a dress rehearsal, for what happens when Japan truly normalizes. Now imagine a full normalization. A 1% or 2% rate increase in Japan could erase years of carefully engineered carry profits. That $20 trillion figure is not hyperbole. It's a measure of exposure. The world's largest liquidity pool, built on borrowed yen, would have to be drained. And here lies the paradox. What saved global markets for 30 years, Japan's infinite cheapness, may soon become their undoing. Because the yen carry trade is not just a financial strategy. It is a mirror of how modern capitalism sustains itself, by pushing risk forward in time. We borrow today to pay tomorrow, confident that tomorrow will behave like today. But systems that never reset eventually reset themselves. The clues are already visible. Japan's inflation has remained above target for 2 years, the first sustained rise since the 1980s. The Bank of Japan faces political and social pressure to protect household purchasing power. And foreign investors are betting, quietly but increasingly, on the yen's comeback. The unwind, when it comes, will not look dramatic at first. It will look like rising yields, stronger yen, and sudden weakness in asset markets far from Tokyo. Then liquidity will tighten. Swap spreads will widen. Risk assets will start to fall in unison, not because of panic, but because the global tide is reversing. And all of it will trace back to a simple mechanism that began decades ago, borrowing cheap yen to fund expensive dreams. Then it was called the carry trade. Today, it's called global liquidity. Different name, same dependency. The system hasn't changed, only the story we tell ourselves about it. If this helped you see how yesterday's logic still rules today's markets, tell me where you're watching from. Every empire leaves a signature, not in monuments, but in its money. For Rome, it was silver. For Britain, gold. For our age, it's leverage. The yen carry trade is not an anomaly in that story. It is the purest expression of how the modern world sustains its illusions. Debt is growth, liquidity is safety, and stability is a promise that can never be withdrawn. Japan tried to escape deflation by lowering the cost of time itself. The world copied it and forgot what time really costs. We learned to borrow from the future as if the future were infinite, but equilibrium always returns. Slowly at first, then suddenly. One day, the same quiet screen that once showed a harmless number, the yen at 160, 170, 180 to the dollar, will flicker. Algorithms will adjust. Markets will stumble. Analysts will search for a narrative. And the story will be the same one that began in the 1990s. The price of free money coming due. The $20 trillion risk no one sees is not the yen. It's the belief that we can suspend gravity. Because in finance, as in nature, what falls slowly rises violently. If this closed a loop you didn't know existed, tell me where you're watching from.